Thanks, everyone. What we'll do is maybe we can just start with a quick round of introductions. If you want to just say a little bit about your fund or your LP, and just maybe a quick line, and then we'll start from there. Amit.
Hi, good afternoon, everyone. I'm Amit Gupta. I'm a founding partner at Equus Capital. We are a secondary focused Asian private equity firm. Largely buy direct stakes as well as provide fund solutions to various GPs and other investors across the region, with China and India being the focus markets for us.
Hi everyone, this is Michael from Portfolio Advisors. We are probably one of the earliest institutional investors in India. First investment made in 2005, so definitely experienced both the up and downs in the market. I would say over the last 3 years, we have re-entered into the market on the primary side. Prior to that, have been quite active taking secondary LP stakes. So the last few years in terms of favorable exit environment has helped us. So definitely looking forward to discuss further.
Hello, my name is Shashank Singh. I'm a partner and head of India for a private equity fund called Apex Partners. We're a global private equity fund with about $50 billion under management, and we set up our office in India about 12 years ago.
Good afternoon. My name is Manish Kejriwal. I'm with Kedara Capital, and we have two funds that we currently are actively managing with a total cumulative corpus of about $1.5 billion. We've invested in about 9 companies in Fund 1 and are deploying capital from the second fund now, where we've deployed capital in two funds. And as a matter of this topic, we've had 5 exits from our first fund.
And I'm Niren Shah. I'm a managing director and head of India for Norwest Venture Partners. Norwest is a 57-year-old fund. We have about $7 billion under management. In India, we've deployed about $800 million, and we've had about 13 exits so far. 6 from IPO and the balance from M&A and secondaries. So with that, I think what we'll do is we'll just jump straight into the first question. It's actually very interesting that we have a panel on exits. If we had done a panel on exits about 5 years ago, we would have had a pretty monoline answer, which was there aren't enough exits, and that would have been the end of the panel. But I think we have tons of perspectives here. So I'll just start by asking Manish that, there's been a sea change in terms of what exits we've seen, especially in the private equity space. Sort of what have your thoughts been? What have been the changes you've seen, maybe from 10 years ago to now?
Sure. I think, as Naren said, if you sat here 10 years ago, there wouldn't be much to talk about. I still remember the whole concept of DPI. Which is the amount of capital one has returned in a fund in proportion to the amount you've deployed, was always a big fat zero, right? And in fact, many of the funds from the vintage when there was a huge amount of fundraising in 06 and 07 still have a situation where they have a very small number of exits. I think many of us in this panel believe, as we were discussing earlier, that this has changed quite dramatically in the last 2 or 3 years. And instead of going into any of the details right now, I would just maybe outline 3 or 4 reasons why that could have happened. I think one, there's been a significantly greater level of awareness that if one is to succeed in the private equity industry, the single most important aspect is giving money back to your LPs. And the focus on that has resulted in a number of deals which were initially 10 years ago primarily minority in nature. You're seeing more and more control or control-like deals. I think, barring the latter part of next year, the second reason is there's been, really good markets. So the IPO market has actually, the public markets have helped IPOs happen. All of 2017 and the first half of 2018 at least, and in some cases the latter half of 2018. And then I'd say just 2 more factors is just there is a plethora of capital amongst private equity companies, private equity players globally as well as locally. So the number of secondary deals has increased on balance. And finally, the strategic interest in India, you see a certain pivoting away from China by many of the global companies, whether it's consumer-led companies, internet companies, and that attention and focus has been moving towards India. If you see what happened with Walmart and Flipkart as an example, you'll be more aware of those details, Naren. But it's an example of large strategic interest in India resulting in an increased number of deals and an increased number of M&A in a situation where there were very few. So if you combine these four factors, you actually see a much higher level of exits in the recent couple of years.
Shashank, I'll ask you something similar. It's basically, is this driven, like the higher number of PE exits, you've been here for 12 years, is it driven a lot by sort of just the ecosystem, the markets, the promoters? What do you think is sort of driving this?
I'd actually echo a lot of what Manish said. I think those are very important factors. There's a couple of other points I would bring up additionally. I think there's a cycle element to it as well, which we shouldn't underestimate. Because if you look at the evolution of the private equity market in India, just in terms of amount of money invested, prior to 2006, it was minuscule. For all practical purposes, the industry didn't really exist. It was maybe $1 billion a year on average. 2006, 7, 8 were big bump up years when a lot of money went in. But unfortunately, that also coincided with a market cycle where multiples were extremely high. And so, the reason for the lack of exits until recently was a lot of money went in at very high multiples. Folks probably overpaid for those assets. And then you were kind of stuck, right? And often, when you overpay for an asset, you build in a very aggressive case. That doesn't happen. It leads to disputes with promoters. As Manish also talked about, the majority of deals then were minority. I remember when we opened the office in 2007, the proportion of buyouts was 5% of the market by value. Last year, it was about 28%, and it's headed north. So you don't have control of that company. You paid a high multiple for it, no control over exit. You're kind of a bit stuck. So I think that, part of it was just that. You pay too high a price and then you struggle. And then I think also linked to that a little bit, the second point I would highlight is actually the industry and industry practitioners were not that experienced, to be honest. There were a lot of first-time investors, a lot of first-time funds that time around, and they were kind of learning the business. I mean, it's a tough thing to say with an LP sitting here, but, people learned the business a little bit on your dime, right, back in the day. And I think those funds that have survived, those investors that have survived, are actually much better at their job. I think nothing teaches you how to really do this business well than a tough fund or a tough deal. You learn a lot. And those are mistakes you won't repeat again, hopefully. So the deals happening now, I think if you go down the checklist, a lot more buyouts, a lot more operating experience within the funds that they know what to do to pull the levers for value creation, a lot more baked into the original the shareholders agreement or the case up front, and then you go and execute. So I agree with all of Manish's points, but I would add a couple of those as well.
Cool. Let me switch to the venture landscape, right? So if you talk to folks, who are doing some sort of venture, or you talk to the whole venture ecosystem, last year was obviously a banner year. We all saw the world's largest e-commerce company got sold. It was the largest transaction ever, and Flipkart got sold to Walmart. Having said that, if you talk to a lot of LPs who are venture LPs, and we'll come to you, Michael, in a bit, but if we talk to a lot of venture LPs, they'll say that outside of that, exits have been sort of very few and far between. So what's your view, Sandeep, on this whole exit ecosystem, the VC ecosystem? What's your view, Amit?
So, although I think you're the best person to address that here, but I'll try my best. I think, I think as Shashank was saying, private equity went through a cycle between 2005 and 2015. I think venture is kind of going through that cycle. It's towards the end phase of that cycle where a lot of investment happens. Ecosystem within the venture world, companies, ecosystem have developed. And I think what we are seeing is that it started to show up in a lot of strategic interest, not only in form of full buyouts like Walmart came in, but also strategic staking bet like Alibaba, Tencent coming, Naspers coming and taking strategic bets in verticals they want to be there. In addition to that, we also see a lot of secondary activity where with the primary fundraise, a lot of secondary changes hand, and I think managers are becoming mature enough to basically say, hey, I'm not going to wait until a Walmart buying Flipkart or an IPO. I'll start cashing in with time in every round. What is still missing is a mature capital market. We've not seen enough capital market deals on the VC side. If you see, I think the closest market behind which we are is China. We've seen over the last 12 or 18 months, they have really opened up. So I frankly think we are where China was about 3 to 5 years ago, where companies were still developing, scaling up, and as that happens, I think over the next 2 to 4 years, if that market develops, I believe that there will be a very healthy exit momentum in the VC side also.
Yeah, I would just add that, since we do a lot of VC, we've seen that in the last 7 years, China has gone from, 20, 30, $50 billion market cap to $1 trillion of let's say, internet market cap or VC market cap, right, of companies created there. So, our thesis on why so many exits haven't happened is very simple, that we're just a little early in the cycle, right? And of course, we have GDP per capita, which is lower than China, but we do believe that the next 7 years are going to be very bright. And I think there are many reports floating around saying that we should have, the market cap of these companies should be anywhere between $500 million to $1 trillion. If you take a 7-8 year out, I'm sure you read the CLSA report, etc. So again, not too many have happened. Not sure if we're going to look at a lot of non-secondary exits in the next 1 or 2 years, but just the companies are becoming very large, and I think in a 3-year plus time frame, we should see like sort of a bunching of a lot of exits. That's my 2 cents. Moving along, I think, Michael, if you can tell us as an LP, the only LP on our panel right now, what have been sort of your views at the top level on how exits used to be from your GPs and how they are today? It could be either PE or VC, whatever you'd like to talk about.
Sure. To echo the previous comments, LPs have gone through their own learning lessons. I think that's beneficial for the LPs as well. And I think what has changed on top of the points that was previously raised is also promoters being more mature. What exactly is private equity? How do you partner with private equities to create a win-win solution? I think back in the good heydays where a lot of low-hanging fruits, promoters just see private equity as another source of financing. Whereas today, promoters understand how difficult it is to grow in today's environment, how competitive it is, and where private equity can really add value. And I think that's also lessons learned from LP standpoint. I think 10 out of 10 of the meetings that we take over the last 10 years, you will see GP saying that they do value addition. But what does that mean? So I think now LPs have a much better understanding and appreciation of what that is and what exactly is the secret sauce. And I think that has really helped over the last 2 years why you see exits coming compared to basically zero, as Manish mentioned before that. So that's very healthy. Now the question is, how does that look going forward? Is that sustainable? the IPO market has sort of shut until the election is over. And the M&A activities, I mean, relative to what we have seen in China, in Japan, in Korea, there's still some room to go, but I think it's moving in the right direction. So whether that can continue, I think from an investor standpoint, you always have to choose, for us, we invest only in Asia, but many investors are choosing between the US, which has done extremely well over the last 10 years. So how do you allocate resources? I think at the end of the day, you need to have a consistent evidence of exit, irregardless of the market environment. Now it's going to be tough, a much tougher environment. So how does the PE and VC community in India, generate liquidity over the next 2 or 3 years? I think it's very important.
Super. So that sort of brings great segue to my next question. Maybe I'll just ask you guys one question each. Maybe start with you on IPO. So Manish, I mean, as an and as Michael is saying, and maybe a lot of LPs saying that the whole IPO market has done really well, and a lot of people have exited tons of companies in the IPO market. Is it because markets are at a peak? Is this a sustainable form of exit? When you guys enter companies, do you sort of look at IPO as an exit, sort of the potential being as strong as it is today?
It's a great question, Naren, and I do think I'll make two, three points on this one. First one is, of course, that the heady markets have obviously helped a lot of the exits. But I would say it's these heady markets would allow many companies to IPO, maybe more than they should allow. There's a certain quality that one wouldn't. But this is where I think, and maybe I'm not overstepping this, it often helps to have a private equity firm as an investor in these companies. There's a perceived difference in the level of governance and performance when there's a PE ownership. So I think my point is, even in markets which are not as heady, you will see the more successful companies IPO, right? And often these being backed by private equity, reputed private equity, gives more comfort to the markets, right? So I think that is an extremely important point. In terms of the IPO market, otherwise, even though it has sort of tightened over the last few months, we have seen the ability to IPO some of our companies because they have quality performance. But I think it's very important to your earlier question that when you're getting into a company, you should have a clear perspective on what your exit is. So normally, before one invests in a company, having a larger controlling stake would probably have a higher preponderance to be able to exit from a strategic sale, a sponsor sale, or an M&A. And typically, all else being the same, a smaller equity ownership would never tend you to go through an IPO. Obviously, there have been situations, even with a larger equity stake, you've seen companies, including us, we've had 3 IPOs in our portfolio from our first fund. And in at least one of them, despite having a very large ownership, we still did an IPO and had enough ammunition to keep, in a sense, exiting. The trick there is to make sure if there are multiple investors, to do it in coordination, such that you're not rushing to the market at the same time.
Just to add to that, you raise a very good point, but I've also seen in the last 3 years, markets have matured that you can do a secondary only IPO. 3-4 years ago, it was almost difficult for private equity investors to exit at a time of IPO, and given the regulations, they'll have to wait for 1 year before exiting. I think markets are mature, and to some point, as Manish said, because of perceived corporate governance and so on, private equity investors can liquidate a chunk of their holding at the IPO, and that's a good change we've seen.
Shashank, do you have anything to add on the IPO, or then otherwise I'll just jump to M&A once? No, or I'll ask you a question on the M&A side.
Sure.
So IPOs, I know you guys have also had IPOs, so if you sort of want to share that, that's great. But I've noticed that both you guys have also had M&As. And that's a form of exit where, at least in the past, right, My US office would keep asking me, where are the M&As, right? And the reason is that, of course, IPOs do happen, good companies can go out, but an M&A in some ways is validation of creating a really sustainably strong company, especially when you're looking at strategic M&As. So anything you want to sort of talk about on what's happening on that side, Shashank?
Sure, happy to. So just to give the overall stats, Niren, out of 9 portfolio companies that we've invested in India, we've exited 4 fully, 2 via sale and 2 via sales of shares on the public market. So I guess the point to add to what Manish said is, and also Amit and Michael, that actually the market is quite deep. It is possible to exit companies even with low average daily traded volume, just by building up interest, selling blocks, and it's a very valid kind of exit route. On strategic sale, I'd say, or sale in general, the 2 that we sold, one went to a strategic. This was iGate, which we sold to Capgemini about 4 years ago now. And I think one of my co-panelists made the point on promoters being more mature. In that case, we didn't have a majority. We were the single largest shareholder, but roughly equal to the promoters in a NASDAQ-listed public company. And we had a tacit agreement from the start that this was going to go to a strategic. That was our best case scenario, in fact, because the promoters were ready for retirement, etc. And there, to Manish's point earlier, I think you have to kind of prep for it from the start. If we knew that that was our kind of best goal, then you build a company where there is a strong professional management team in place, so that a strategic coming in sort of says, okay, the team is going to come with the company. If there is no over-reliance on promoters or anyone else. You have systems and processes that look like they would for any multinational, such that it's a plug and play when it comes to buying an asset. And then you sort of time correctly, which is you find the best multiple, the best time. And different people have different philosophies on how to sell. Some strategics will participate in an auction. In the case of iGate, it needed a lot of sort of one-on-one contact with Capgemini. They had to be kind of cajoled through the process and made to feel important, and that's kind of when they stepped up. In the other exit that we had, also GlobalLogic, it ended up going to 2 private equity funds, but that's actually because the strategics, believe it or not, were not willing to pay that multiple. So the PE funds paid a higher price for growth, and I'm thrilled to say that, a year later, the company is outperforming the plan we'd given them. So it was a good quality company. Maybe strategics didn't realize it. Maybe that, public companies didn't want to step up. But in general, I'd say we've had a pretty good experience when it comes to exits in India.
The only thing I'd add in here to what Shashank said was, in the Indian context, the added complication which used to, in the earlier years, prevent exits was many of these companies that we invested in were co-owned by families, started by families, co-owned by families. And even if you had a large equity interest of, let's say, 25 to 50 or 60%, it was often perceived, and was maybe the case 10 years ago, the families did not want to sell these companies. Today, in 2 of us 5 exits, we co-own these companies with founders who were businessmen and even their children who were involved in their businesses. But we jointly sold the company together, not just us, but also the promoter and founder of the company, to either, in one case, a sponsor who was willing to pay, like Shashank said, more than a strategic, and in the other case, to a global strategic. So the whole concept of family ownership and them not wanting to sell out the family silver, we're seeing a change in that mindset. But again, as we said earlier, very important to have that discussion and agreement when you're entering the company, to have very clear clarity on what the 5 to 10 year plan is. Where does the family want to be engaged, and where do they see themselves in 5 or 10 years?
Yep, absolutely. And then, the sort of last but not the least, secondaries, right? And Amit, if you can talk about those, that's become a very large and viable exit, whether it's to secondary funds or to other private equity. Even in venture, we've seen a bunch of large transactions happen where people have put together assets and sold that to funds like yourselves. Can you talk a bit more about secondaries and more on insights of why people are doing this and where do you see this trend going?
Yeah, no, before I get into secondaries, I think one point that I make clear is people like us only exist on a thriving exit market. Eventually, we also need to exit, and if there was no M&A strategics or capital markets, can't be a black hole which keep buying in. So all these things all these development that we've seen in India in the last 4 or 5 years, essentially is one of the reasons why we've started seeing secondaries also flourishing. Largely because secondaries is generally an alternate liquidity solution, where we are extending the time frame in which the company remains public or remains in the setup that it was supposed to remain for 5, 6, 7 years, but would need to be getting longer. We think having said that, I think with the players like us, the market have matured. Secondary markets have matured. 5, 7, 10 years ago, they only used to be small LP stakes that used to trade in Indian secondary context. We have now seen direct deals that happens. We've also seen portfolio deals that happens, and we've also, as you mentioned, we ourselves and some of the other large global players have been involved in interesting opportunity in fund solutions deal, where you are essentially working with the existing manager or team that is managing the assets and trying to figure out what liquidity solutions require. And in some cases, for example, end of fund life, which is as Shashank mentioned, 2006-07, still remain one of the largest fundraising vintages in India, where once the fund have started competing 10, 12 years of their fund life, some of the LPs want to change their views on how long they want to hold, whereas the GP thinks another 2 to 5 years can really pay off on all the hard work they have done in 1, 5, 6, 7 years. Overall, I think the reason we see market opportunities and both in the VC side and the primary side is largely because we think a solution-driven approach can help unlock value, and as GPs mature, to Shashank's point, and the private equity industry gets into second phase, people are now building scalable businesses rather than getting into a position where you just buy assets and manage it. People are looking at secondaries as a good portfolio, manage their portfolios, basically saying, okay, with a given team of 10, 15, 20 people, I can't manage 100 companies, and at some point in time, it's better to start selling. I think we are still far behind the Western concepts of secondaries. I think there are a lot more tools that are yet to yet to come to Asia, in India in particular. But overall, if you see, we are now, we're delivering $15-20 billion of exit a year. And I think, given the nature of the market, between 15 and 30% of those exits come from secondary players, either like us or as Shashank mentioned and Manish mentioned, secondary between private equity firms.
Cool. And Michael, just in terms of if you can provide an Asia perspective compared to India, just in terms of exits, etc., how are you seeing sort of Indian exits develop?
Yeah, I think there's still a gap, and I think it's moving in the right direction, but there's still room to grow. And I think it's the beginning of a more mature exit environment in India, which is a great development. But I think from IPO standpoint, for example, I think what you see is the ability to list outside or in more than one market. I think right now today, Indian companies, I think the last one that I know, back in the good old days, make my trip, listed on the NASDAQ. but you don't really have a very viable option to list outside of India today. Similarly, for the VC investments outside of Nasdaq, Hong Kong is probably last year has made a change and allow companies that are not profitable to list, and you have companies like Xiaomi, quite a number of pharmaceutical companies listing on the Hong Kong Stock Exchange and getting a lot of liquidity. So I think all these developments are to come in India, which is going to be positive, but there's still some room to grow. I think for M&A, secondaries, there's a lot of larger funds that has focused in or refocused in India, which is helpful in creating secondary exits, both from GPs, from secondary funds like Amit's fund. Sometimes we are seeing in Asia, restructuring has happened in a big way. Last year, there's quite a number of large transactions aggregating over $1 billion, where GPs actually selling portfolios to new investors, similar to what Amit has mentioned. That has not really come in a big way in India, but it has to be a combination of good GPs, good assets, and therefore demand for giving extension to the GP. So that is also something that can grow further.
Great. I think that probably, we're out of time, brings us to the end of our session. Thank you very much. Please join me in thanking our panel for their views on exits. Seems like we have a good time coming on exits. I think we need to keep producing quality companies, but if we do that, India has a long way to go. Thank you very much.